I bet you would like to invest like Warren Buffett. On average, he makes 10, 20, 30 million dollars a day. Not a year, not a month, but every single day. After watching this video, you'll be able to modify, improve your investment strategy regardless of whether you already have $1 million invested in stocks or you are just starting out. In either case, you'll be able to invest like the most successful investor of our time and one of the wealthiest men in modern history. The great news is that investing like Warren Buffett does not require a stratospheric IQ. All you have to do is learn and apply the principles I'm about to share with you right now. Pay attention though. Sometimes Warren Buffett says one thing while doing quite another. Some people even say listen to Buffett and do the opposite. So we are going to be analyzing Buffett's actions, not his quotes or advice. Let's get straight to the point. I had some lucky days in my life, Warren Buffett said in his interview, but one of the luckiest was in 1949. What do you think happened on that day? Did he win the lottery? Did he inherit $1 million? I picked up a copy of The Intelligent Investor. Not only did it change my investment philosophy, it changed my whole life. I am an avid reader myself, and I totally agree with the readers are leaders mentality. The more you learn, the more you earn. This is a super powerful advice from Warren Buffett. We cannot ignore it. You can go to Amazon and search for investing, investor, invest, and you'll see that the first search result is The Intelligent Investor by Benjamin Graham. What's really fantastic is that even though it was published in 1949, 70 years ago, nothing has changed. Nothing. New companies have been created, old companies have gone bankrupt, but their principles are still the same. So tip number one, as you've already guessed, get this piece of wisdom which hasn't lost any of its relevance. Read, reread, because this is what Warren Buffett investment strategy is based on. Now it's time to see what exactly Uncle Warren learned from this book. Tip number two, analyze for long term, not for short term. Basically, this means don't go for crazy profits. You know what it means, don't you? In today's world where there are plenty of 20-year-old Bitcoin millionaires, penny stock gurus, and thousands of experts teaching you how to get rich quick and retire within the next 5 years, it's not that easy psychologically in the first place to avoid the temptation. The key to getting rich, according to Warren Buffett, is getting rich slow. His track record shows that he has achieved an annual return of only 21% over 52 years. This is probably the best real-life example of the power of compounding in modern history. Never trust the market. Let me share with you how I understand this advice. Here is an S&P 500 chart, which, as you know, reflects the state of the US economy. Pretty good performance. Nothing to be worried about, right? More and more people buy stocks, only stocks through mutual funds, ETFs, direct investing, gold, silver, real estate, bonds. As an intelligent investor, you should ask yourself why it behaves this way, what might happen in the future, and what's more important, how it will affect the stock you're about to buy. Another tip from Warren Buffett is stick to a strict formula by which you make all your investments. As I understand, it might be ridiculously easy to come up with. For example, today plenty of people are astonished by the power of compound interest, which was called by Isaac Newton the eighth wonder of the world. So the formula might be as easy as make a commitment to yourself to invest $5 per day in an S&P 500 index or Vanguard ETF or something like that. Just an example. As I've already mentioned, Warren Buffett never looks for crazy profits like 1000% per year. He focuses on safe and steady returns. Invest in what you know, what you understand, what you are familiar with. Example, look what I have here. Nice stock, isn't it? Do you know what it is? Many of you have never heard about this fantastic company, but I have. EPAM Systems. It's a global provider of software engineering and IT consulting. EPAM stands for Effective Programming for America. In a few words, they have hundreds of offices with over 30,000 employees in different countries, mostly in China, India, some European countries like Bulgaria, Ukraine, Poland, Czech Republic. You get an idea of how this company works, don't you? Instead of hiring a software engineer in California and offering him a salary of $200,000 per year, they hire an expert of the same level somewhere in Europe or Asia and offer him $30,000. I understand this business model in particular because I have a few friends who work for this company and they say it's growing. The salaries are going up, new offices are constantly being opened. This is why I for myself can predict that more American companies will need more IT services from this company in the future, and I believe it's a great stock to own, not because it's growing, but because I understand why this is happening. On the other hand, when I see some positive expectations and predictions about, for example, pharmaceutical drug manufacturers, I don't even care about that because I don't know how this industry works. Well, I know that they produce substances which alters the body's function, but it's not my interest. If I ever decide to buy a stock of a pharmaceutical company, first I will have to learn how this industry works in general, as well as whether a particular stock is a subject to speculation, manipulation, which opportunities and challenges it's facing now and will be facing in the future. It may take an hour, a day, a week. Only after that I will be knowledgeable, qualified to make my own decision. A classical violation of this principle, invest in what you know, is cryptocurrencies. Thousands, if not millions of people invest in Bitcoin and other cryptos, but they don't have a clue what they are, how they work, what factors influence the price, and so on. Yet another example, and we'll get to the next tip, is gold mining stocks. I myself am a fan of investing in physical precious metals. But before I invest in gold mining stocks, I will have to get familiar with how this industry works, what it depends on, how these stocks will behave during the next financial crisis, and so on. Tip number 7. Don't look for something special, something unique, something most people don't know anything about. Warren Buffett's investment portfolio will surprise you. His favorite stocks are Coca-Cola, Apple, Bank of America, Wells Fargo, Visa, American Express. We all know what these companies produce, don't we? I often see these articles, these predictions on the internet. Best 10 stocks to buy in September. 10 killer stocks to buy that no one knows about. What I know is that there are over 4,000 public companies in the United States and over 100,000 publicly traded companies in the world. I'm not saying that it makes no sense to be looking for some interesting, unknown investment opportunities. I'm just sharing what I've learned from Warren Buffett's investment portfolio. Genius lies in simplicity, in other words. The next tip is of great importance for every single investor. I'm not talking about traders. Ignore day-to-day market fluctuations. Invest for the long term. Example. Today, when I'm making this video, many investors believe that Tesla stock is a great investment. There is a reason for that. Not only does Tesla produce more and more electric cars year by year, but electric cars in general are getting more and more cost competitive and more popular. But let's take a look at a Tesla stock 5-year performance. What we see is market fluctuations. Warren Buffett's investment strategy, if he were to invest in Tesla, I think would be easy. Either he would invest for a long period of time, 5-10 years, or he would just stay away from it. But how does Warren Buffett identify stocks? This leads us to the next tip. Identify cheap, undervalued stocks. In a few words, this refers to a stock that is selling at a price significantly below what is assumed to be its intrinsic value. There are some formulas to calculate intrinsic value, even calculators. In simple terms, intrinsic value is what the company is really worth. Its real value. You might say, isn't it a market capitalization? And the answer is no. The market capitalization is the price that investors are willing to pay for the company now, today. The intrinsic value, on the other hand, is what the company is really worth. I'm not going to go deep into the details because different investors use different approaches to measure it. Here is a quote from the Warren Buffett's message for investors. Intrinsic value can be defined simply. It is the value discounted of the cash that can be taken out of a business during its remaining life. And tip number 10. Warren Buffett has always been a fan of companies paying high dividends. Apple, Coca-Cola, and many other companies have already brought him billions of dollars. Now a bonus tip. How do you invest exactly like Warren Buffett? Here's the answer. When we are talking about Warren Buffett's investment strategy, we refer to his company, Berkshire Hathaway. This is an American multinational conglomerate holding company that owns either wholly or particularly Geico, Duracell, Dairy Queen, the Coca-Cola Company, Bank of America, Apple, and many others. In simple words, if you want to invest like Warren Buffett, you can go and buy Berkshire Hathaway stock. It's a publicly traded company like thousands of others. Are you getting it? Warren Buffett's investment portfolio is not secret. You can become a partial owner of Berkshire Hathaway, which in turn invests in other companies in line with the strategies of Warren Buffett and his team. You don't have to buy Apple shares, decide whether it makes sense to invest in Tesla or it's time to sell Bank of America. You just invest your money in Warren Buffett's company, Berkshire Hathaway, and they work for you. The company is public. What about its performance? Here it is. Well, it grows. You might think, so what? Everything is growing now. Look at this. The common question is, does Berkshire Hathaway outperform the S&P 500? And this is the answer. But here is the most important part of this video. It might surprise and even astonish you, but the reality is Warren Buffett has crushed the market for several decades, but those good old days may be over. Had you invested $10,000 in Berkshire Hathaway 10 years ago, today you would have $24,000. But at the same time, had you invested the same amount of money, $10,000, in the S&P 500, in other words, in the 500 largest companies in the United States, today you would have $32,000. In a recent interview with Financial Times, Buffett said, if you want to join something that has a tiny expectation of better performance than the S&P 500, I think we might be about the safest. In other words, he himself believes that Berkshire Hathaway, which is based on his investment strategy, has only a tiny chance of outperforming the market. What does it mean? Warren Buffett acquired his wealth by making smart investment decisions. But now, today, he cannot beat the market anymore. Can you? Yes, it's important to read The Intelligent Investor. Yes, it's important to educate yourself. But the reality is, if you can merely match the S&P 500 minus a small fee, you'll be doing better than the overwhelming majority of investors. Of those, I mean, who invest directly. All am I asking for the work I've done is smashing the like button, subscribing to my channel. Also be sure to watch my other videos and let me know what you think about Warren Buffett, Berkshire Hathaway and his investment strategy. Until the next time.